Buddy, happy Thursday. Welcome to another masterclass. We're excited to have you and to have a special guest, Cornell. This is going to be an absolute treat. We had Cornell last year and everyone loved it. So he's going to be talking about everything from saving, investing, ETFs, and also going to be sharing a really cool opportunity for all of us to join the Canadian Financial Summit, which is a free summit of some of the top financial experts in the country coming together and teaching you different financial topics. So no matter where you're at, there's going to be one or two presentations there that can have a huge impact on your finances, whether you're in debt, saving, investing. There is a link in the chat room. If you haven't already, please get signed up. So I'm going to do a quick intro for Cornell, and he's put together this amazing presentation. So while I'm doing the intro, in the questions box, just say welcome Cornell. Give him a big warm welcome and thank him for being here today and you know, donating his time, really. And he's really busy right now with his summit. So Cornell, for those of you that don't know, he is the host of Build Wealth Canada podcast. And if you haven't heard this podcast, you need to listen to it. It's the #1 podcast in Canada around personal finance by far. He's got some of the best financial experts that he interviews, and not just experts. Like I was listening to an episode a couple of weeks ago, and he was talking about some of the services he uses. So it's unbelievable, especially for those that are really looking to invest, grow their wealth. He's got some incredible episodes, resources, and information there. And really what Cornell is known for is he paid off his mortgage in only 6 years. He was still in his 20s, which is insane. I don't even know how that's possible. And he became one of Canada's youngest retirees. He retired at 32 years old. And so since then, I think he wanted to continue to work on something that was a little bit more fun. So he started this, you know, personal finance podcast, and it just went wild, right? He's got 1.1 million downloads. He also runs the largest personal finance and investing conference, which is the Canadian Financial Summit. He interviews the best experts, best practices, tips and tactics when it comes to investing, financial planning in Canada. It's unbelievable. It's totally free, which is unreal. It's one of the most attended conferences in the country, and all of you are invited to it. There's a link in the chat box, so definitely click that link. So Cornell, welcome aboard. And we were just chatting before this. I asked Cornell, what is the most exciting session of the summit that you just cannot wait for people to watch and get that information? So I wanted to ask you that and share what your favorite section is, Cornell.
Awesome. Yeah, and thank you so much for that warm intro. That was really nice. I was trying not to blush while you were saying. But yeah, to answer your question, yeah. So I mean, we had some amazing speakers. I mean, we've got like over 35 presentations and then interviews, and it's just awesome. So really excited. I have a whole like bigger team kind of behind me now that helps assist everything, and so we're able to go even bigger this year. Like we're gonna have over 20,000 people, Canadians, attend this year, which is just huge. So really awesome. But yeah, to answer your question, the one that I'm really excited about, because it's a little, I guess, nostalgic a little bit as well for me. And so when I know you've mentioned this resource before, so Money Sense, you know, even back when they had the printed magazine, you know, every year they would publish the top ETFs guide, right? You know, where they have a panel of experts. Jonathan Chevreau is the one that would write it, and you know, who's like a really famous writer in this space alone, right? And I remember when I was first learning to invest, and you know, you get that information overwhelm. There's so many ETFs, so many investment options, and so the Money Sense Top ETF Guide really helped narrow things down for me, right? Obviously, I used other resources too, because you're supposed to be thorough in your due diligence, you know. But I remember that was like, oh, thank you for making it a little easier for me with my short list. And so they continue to do this every single year. And what we did for this year is I thought it would be so cool to actually interview John, as well as one of the panelists, which is Ben Felix from PW Capital. Really, and when you listen to the interview, like the guy really knows his stuff, to say the least. And so it was really fun to kind of go and do like a deep dive on that top ETF guide, because they describe it a fair bit in the article on the Money Sense site. But they have the table there, so you can see the top ETFs. But I know when I look through it, there's always like questions like, oh, well, why did you pick this one and not that one, right? Things of that nature. Why would I pick this one and not this one? And so in this interview, I was able to basically interview those guys and really ask them those questions and do a deep dive. So because we don't want to just see a list, right? We want to actually understand why this one might be better for your situation versus this one, right? And you can make that decision yourself by having more sort of information, right, in your arsenal. So I'm really excited about that one. But I mean, we have some, like I said, amazing guests, amazing speakers. That one just in particular really stuck out to me because when I started investing like almost 10 years ago now, that was one of the things. And so now to be part of that and to be able to build on top of that with a video format and a presentation and interviewing them, it's just surreal. It's really cool.
That's amazing. I think it's so important for people to get insight on how to actually analyze an ETF. Let's go behind the scenes. What are they looking at? What are they thinking? And I can't wait to watch that. I am so excited. So that's amazing. But again, Cornell, welcome.
Thank you.
I can't wait to check out this presentation. I know you put a lot of work into it and made some changes from last year. So I am going to grab some popcorn and a nice green tea, and I cannot wait to check this out.
Sounds good. Yeah, so this is all updated. So I did a similar presentation last year on the tops or commonalities, things that I've learned from the different experts. But then there's so much that I've learned after interviewing these dozens and dozens of experts, both on the podcast and on the summit. So these are, new. This is a new, the 2021 edition, basically, of this presentation with some new sort of like tips, strategies, and things you can do. All right. So should I just get right into it?
Yes, absolutely.
Awesome. Yeah, so I'll go through this real quick just because Arian already gave me that really nice intro. But yeah, basically, I'm the host of the Build Wealth Canada podcast. It's ranked #1 in the investing category out of all the Canadian investing podcasts. Obviously, the rankings fluctuate, but it's like always #1 or #2 pretty much for the past 7 or so years. Over 1 million downloads, good ratings. And so the reason I bring this up is because the podcast has gotten so large and so successful, people want to be on the show, right? And so that has allowed me to get some really, really high quality guests, like some of the top sort of minds in the space in Canada, and in the US too, because there's a lot we can learn from the US as well. But this is specifically for Canadians, right? So you're not going to be hearing about things like 401ks and things that, there's some great blog posts and podcasts in the US. But then as a Canadian, you're always wondering, well, hold on, does this apply to me? Is it the same in Canada? Is it different? You don't really know, right? So with this podcast, it's specifically, unapologetically, it's for Canadians. And so some of these speakers that are on it, I mean, they either charge hundreds of dollars like per hour, to be, if you want to pick their brain privately. A lot of them don't even do one-on-one consultations, right? They just don't do that because they're busy with their other projects, things like that. And so because of this podcast, I'm actually able to get them on, pick their brain, have them share these different best practices, and then I basically share it with the rest of Canada, and so that we can all learn from these experts. And so the topic for the presentation today, how that came to be, is when I started interviewing all these different experts, both on the summit and on the show, you start to notice these commonalities, right? So if I interview 10 really respected individuals on ETFs, and if 100% of them or 90% of them tell me a certain thing that they say, yes, you should do it this way, or this is definitely a thing you should consider because it's really good to like save you money on fees or taxes or whatever, then my ears perk up a little bit, right? Because if these top respected people, if they're all saying the same thing, we should probably listen, right? They know what they're talking about. And so that's what this presentation is. It's kind of a summary of those key lessons. So last year, I think we had, I think it was 5 or so things learned, like 5 commonalities that I hear among all the different experts. And here's another 5 that we have for this year. So so definitely, I hope you enjoy it. And thanks again for having me back. And then, Arian already mentioned the Canadian Financial Summit. So sharing best practices from some of Canada's top personal finance experts. Again, it's a totally online event. You don't have to book a hotel or drive anywhere. You can view it all online. You can stream all the talks totally for free to attend. It's happening next week. So definitely sign up now so you don't actually miss it. In the orange here down below, this is the special link that I created specifically for Enriched Academy. So it's just CanadianFinancialSummit.com/EA free. The EA stands for Enriched Academy. So if you go to that link, you'll get to a page, and you'll be able to sign up right away to get your free ticket for the summit. And then so on the 22nd, 23rd, like I'm going to be sending you an email when the videos are released for that day, and you can start streaming them whenever you want. And like I said, it's all free, so definitely take advantage of it. It is next week. It's like a time sensitive thing, so definitely check that out. And again, that's the special link. All right, so let's get into it. Oh, and in case you don't, you forget what the link is, it's also at the bottom pretty much of each slide. So it's right there, just canadianfinancialsummit.com/EA free. All right, so what are the commonalities among the experts? So here we got 5 lessons. Lesson 1, passive total market index investing is the most frequently recommended investing strategy. Now, this is really the only lesson out of the 5 that I have today that I actually touched on last year as well. But the reason I wanted to touch on it again this year is because 1, it's really important, but 2, we have some new stats, some new figures to share with you, some more up-to-date stats, right? Because there's always this debate, should you do passive investing? Should you do active investing? Which one tends to perform better? That kind of a thing. And obviously those numbers change every year, right? So last year it was an overwhelming sort of seeing overwhelming evidence that if you are a passive total market index investor, that you are more likely to actually do better than if you are an active investor. And so, well, let's look at the stats for this past year, and is that conclusion still the same? So we're going to look into that in just a moment. But for anybody that's just totally new to this, maybe you're not really sure what I mean when I say passive total market index investing. So when it comes to investing, there's sort of 2 camps, right? There's the active investors, and then there's the passive investors, right? So the active investors is, when you think of like a stock picker, for example, right? That would be an example of an active investor, right? So they are not just content with getting the returns of the market, they are trying to beat the market, right? So they're trying to find the next hot stock, whether it's like undervalued or whatever the case may be. They're trying to buy in on it, and they hope that that's going to really, go way up, and they're going to be able to beat the market with these kinds of stocks, right? So a very active approach. To do it right, you actually have to be reading the financial statements of the companies, checking out their annual reports, doing your own research, using different tools, that kind of a thing, right? The passive total market investing kind of is that other camp where, and this is, and full disclosure, this is all that I do completely. Like I'm a purist when it comes to passive total market index investing. That's all that I do. So I just buy ETFs, and those ETFs are basically a representation of the market as a whole across the whole world. So there are basically 4 ETFs that I buy all the time, and I'm happy just getting the returns of the market. So if the market does great, I do great. If the market doesn't do well, I don't do well. But long term, from what all the sort of evidence and research that I've done, this is really what we used to a huge component that we used to be able to become financially independent when we were 32. And yeah, so definitely, worth thinking about and worth understanding for sure, as it can have a drastic impact on your life. All right, so let's look at the updated stats for this year. So this is a brand new chart from this year, and so really what happens is, with a lot of times, if you're getting into investing, maybe you go talk to someone that sells mutual funds, something like that. They're going to say, and then they're trained, right, on trying to persuade you to go with their high fee mutual funds that are actively managed, because they say, hey, look, we've got people that we employ, we've got some amazing analysts on our team, they're going to be able to beat the market. Why would you settle for the average market returns when you can beat the market, right? And so that is sort of their claim that they tend to say. But let's look at the actual numbers. So in Canada specifically, and this is as of December 31st 2020, that's the last time that this sort of the latest numbers that have been published, 98.63% of funds, so these actively managed funds, underperformed the S&P TSX Composite. So that's the index for Canada. 98.63% underperformed. So only 1.37% of funds outperformed the S&P TSX Composite. So in this scenario, then, if someone is trying to sell you mutual funds and saying, hey, why would you do the index when we can beat it? They're basically saying that, okay, at least for the Canadian equity portion, they're saying, hey, we are that 1.37%. The team and I, we are that 1.37% that's going to beat the market, even though 98.63% of their peers who are also trying to get their business have underperformed the market, right? So again, this really drives it home that there are going to be some active investors that do beat the market, fair enough. But when you look at these percentages, right, the odds are more with you if you're just a passive index investor. Let's look at the stats for the US. I'm not going to go through every single geography. I think you'll get the idea after I show you the US one. Not as extreme as Canada, where it's like, in the 90s, plus percent. But in the US, same kind of story, right? 75.27% underperformed the S&P 500, which is one of the main indexes for the US. Only 24.73 beat it, right? So even in this scenario, even though it's not as extreme as in Canada's case, still, if someone's saying, hey, we're going to be able to beat it for you, are you sure? Because over 75% of your peers are making the same claim, but they're actually underperforming the index, right? So again, something to really, really have on your radar. And this is why I wanted to tackle this again from last year, because again, we're looking at these numbers this year, and the conclusion is in fact the same as last year. The passive index investors on average do tend to outperform the active investors. Just gonna grab a quick sip of water here. So this is another chart to illustrate a similar point. I was actually invited by BMO, so Bank of Montreal, to do a presentation with them on core ETFs and on these types of ETFs. And this is a chart that they put together that I thought helps illustrate this point even further. So here on the bottom, you see the different types of investments. So you got U.S. equity, Canadian equity, global equity, different types of equity across the world. And again, what you want to look at is the dark blue section. So the light blue is 1 year. We don't care so much about the 1 year, right? Sometimes it's going to do good, sometimes it's not. When we're investing, we are typically either investing for a retirement, which is a multi-decade long thing, right? So we care about long term, or we're saving for our child's education through an RESP. And in that case, it's also a longer term thing, right? Like over a decade typically, right? So we don't really care so much about the 1 year, we care about the 10 years. So let's look at the dark blue chart, and you can see again similar numbers. So the numbers above the blue chart, that's how many of these equity funds underperformed their benchmarks, right? How much did they underperform? And so again, same as I was showing in the other slides, you can see typically between, let's see here, 84% to 97% underperformed, right? So again, the passive index investors won essentially, tend to get higher returns than these actively managed ones. The closest one was, you can see the second one, 65, right? 65% for the Canadian small mid cap equities, right? So even in that scenario, the index investors still ended up on top because only, and I'm you're kind of using air quotes here, only 65% underperformed, as opposed to like 97 percent like we see in one of these cases. So again, just drives that home point even further. And this is, I see stats like this, and it's like, yes, this is why I am a passive total market index investor instead of being, an active stock picker trying to beat the market. Because even the people that do this professionally as their job, are not able to do this, especially once fees are factored in. This is another chart. You might have seen this last year, but I really want to show you again real quick because it really drives the point home. So when you go and you get pitched by some of these companies, these salespeople that call themselves financial advisors, but they're really salespeople, a very common argument that they have and that they get sort of in their training when they're trying to, they get trained to persuade you to not be an index investor, is they'll say, well, look how good our fund did last year and the year before compared to the index. We beat the index. Why would you buy the index if you could have had our fund? Look, it actually outperformed. Okay, that's great. But then the question is, again, we don't care about how it did last year or the last 2 years. We care over longer periods of time because, again, we're investing for the long term. And so this particular study, what it shows is basically they took the top quartile of performers, right, the top funds. So from 2010 to 2014, they grabbed the best ones. And then they looked at how many of them actually stayed at the top, how many of them continue to be in the top quartile for the years afterwards, so from the year 2015 to 2019. And the answer, only 15%, so 15% remained in the first quartile. So if you are ever getting pitched investments and they're saying, look, we dominated the index last year, why the heck would you ever be an index investor when you could have had our fund? It's like, well, that's wonderful, good for you, but how long of a time frame are we looking at? Has this specific fund that you're showing me that you claim beat it last year, has it actually what's sort of the long-term frame? How has it performed in the last 10 years, for example, right? Because as you can see here, it's extremely difficult for them to remain in the top spot. And that's like a whole other presentation on why that is. There's specific reasons for it, but it's very, very just the nature of the industry, the nature of the beast. It is very difficult for these funds that actually do very well to maintain that top spot. And so once again, why bother with that? Why bother with trying to pick the best fund when you can just be an index investor? Just buy the market as a whole and you're done. Okay, this, I'll go through this real quick, illustrates basically the same point, but just in a different way. So if you look at the highlighted area right here, here we're just looking at large cap funds just as an example. So again, they took all of these funds, 10.55% of them actually beat the market. And so then what they said is, okay, over a 3-year period, they beat the market, but what happened? How did those funds do that beat it? How did they do in the 3 subsequent years? You know, were they able to retain that top spot? They beat it in the first 3 years. Were they able to beat it for the next 3 years? And in this particular example, none of them were able to actually continue to do that in the next 3 years, right? So again, you really, this is something to have kind of in your toolbox, that when someone's trying to persuade you, you really got to look at, okay, just because it did good in the past does not mean it's going to do well in the future. And if you look at some of these other like small cap value, large cap value, it's the same kind of story. It's extremely difficult for a fund that does well for a few years to continue to do that well long term. And again, that's why I'm very pro on the index investing front. Okay, and one thing that really kind of sealed the deal for me, like put the nail in the coffin, when I was first starting to invest, when you're starting, you're not sure what you want to do, right? Do you want to go active? Do you want to do passive? Do you want to do a combination of the two, right? And so I was trying to get both sides of the story, right? I have a ridiculous amount of good things about passive total market index investing, and I thought, okay, I want to hear some cons, right? What are the cons of being a passive total market index investor? So I thought, well, let's find people who really know their stuff, who perform very well on the active investing front, right? Let's get the top people from that other camp, and let's see what their arguments are for why active investing is better, right? Because that's what they do. So clearly they must think it's better than passive, right? And so obviously Warren Buffett comes to mind, arguably one of the world's most famous investors. And so again, he's an active investor, right? But if you look at some of his quotes and what he's suggesting to his kids and his family when he passes away, he also suggests that, yes, and I know Arian's brought this up before in some of his presentations, the quote that he has is that, that he actually wants them to just do passive, index investing, because in his case, that's his job, that's his craft. He decided that he's going to become amazing at it, and he has been able to do that, right? And so for him, active investing is a good fit, right? But I would say, for 99.9 something percent of people, we have our lives, right? We don't. This is not something that we want to spend our weekends doing. This is not something that is our job, right? We have our other jobs, right? We don't want to spend all our time investing, right? If that is something you want to do, then go work on Bay Street, go work on Wall Street, try to be the next Warren Buffett. Awesome. But I would say for the mass majority of Canadians, we're not in that camp, right? We're not trying to be the next Warren Buffett. We've got our own jobs and we've got our own lives, and we know investing is important. We know we got to save for retirement. We know we should probably do RESPs as well for our kids. So we just want to get that part taken care of, because it's important as responsible adults. That's what we should do. But then we want to go on and be able to live our lives and not always be worrying and thinking about it and always reading company reports and things of that nature. So when Warren Buffett suggested that was like, oh, interesting. So he's kind of in that other camp, and he's still recommending index investing. Very interesting. Peter Hudson's another example. This is an actual Canadian example. I've interviewed Peter multiple times already. He's actually at the Canadian Financial Summit again this year. He's also going to be doing a live Q&A. So for people that get the All Access Pass, you can actually ask him questions, things like that. So a lot of people still want to do some active investing like on the side because it's enjoyable for them, which is great. But I remember I interviewed him way back for the first time, and I asked him the same thing. I was expecting him to tell me all these reasons why passive investing is a bad idea, and he didn't say that at all, right? It was again, it's actually a really good fit for a lot of people, right? And yes, active can be good for some people for some situations. In his case, he ran one of the largest hedge funds in Canada, right? He's very good at it. He can actually beat the market on certain years, right? And so that's his craft. That's what he does. And so he's decided to dedicate his career to that, right? And that's great. But again, for people that don't want to go down that path, there is an easier path, which is just passive index investing, where you just accept the returns of the market. It's a ton less work. You don't have to be reading financial statements on the weekends, to see if you should switch companies or whatever the case may be. So again, when I heard, especially from these two particular experts, one arguably the most famous active investor in the world, the other one of the most famous active investors in Canada, and they were both actually not knocking passive index investing, I was like, okay, this is interesting, right? It kind of put the nail in the coffin for me in terms of like deciding, I'm definitely going to go passive. Passive is the approach for me. Hopefully that made sense. It made a big impact on me. All right, so that was only lesson 1. Lesson 2, consider asset allocation ETFs. So why is it easier than ever to be a do-it-yourself investor? And I would argue the answer is asset allocation ETFs. And I guess I should do like a little disclaimer. So obviously treat this as helpful tips in education. I don't know your personal situation, right? So this is just things that I've heard, that I've researched, that I do myself, right? They work well for me. They've worked well for many others. That's not a guarantee that it's all going to work perfect for you, because again, I don't know your situation, right? So obviously do your own due diligence, do your research, talk to your financial planner, not a mutual fund salesperson that calls himself a financial advisor, like you get like a fee for service financial planner. Enriched Academy has an amazing coaching program. Take advantage of that, right? Talk to someone there, right? And get their, get their opinion, so that it's more kind of custom for your situation. Okay, asset allocation ETFs. So what are they, right? So when I first started investing, these actually did not exist. And so I needed to get an ETF to get good global diversification from an index perspective. I had to buy a Canadian ETF, basically an ETF that represents the Canadian market, the US market, international emerging markets, and international developed markets, right? So there were 4 ETFs. And if you wanted to do bonds, you would get a bond ETF as well, right? So you had to have those. So you basically usually have 4 ETFs, maybe 5, depending of if you wanted some more, but typically that's what it was. And you had to rebalance, and you had to figure out, okay, what's the one I should use for Canada, what should I use for US, etc. And so that was the option, and so that made it difficult for some people, right? Because then you've got to rebalance your portfolio, you've got more ETFs to choose from. It makes things a little bit more complex. It is still, I would argue, the lowest cost way to invest. It is still, I would argue, the most tax effective way to invest, because you can, when you have them individually, you can put them in the right accounts. It kind of gets complicated from a taxation standpoint, but basically you're able to be very nicely optimized from a tax perspective. But that's only really worth doing once your portfolio gets a lot larger. Like the number I like to use is $200,000. So if your portfolio is under 200,000, then I would say there's a really, again, I don't know your personal situation, but you're probably better off with just asset allocation ETFs. Once your portfolio is at 200K plus, then it's like, okay, it's big enough now where these like small incremental optimizations by having ETFs individually, that's actually going to start paying off for you a little bit. So something to consider. But I'm getting a little ahead of myself. What are asset allocation ETFs? I should probably define that first. So with asset allocation ETFs, instead of buying those 4 ETFs, for example, or 5 ETFs, you're buying just one ETF. And think of it as like a basket, right? So an asset allocation ETF is like a basket, and inside that basket is those 4 or 5 ETFs that I mentioned, right? So you're getting global diversification, you're getting indexes from the whole world, but you're just buying one ETFs. So that's really what they are. So they make things a lot easier. So why they might be a good fit for you? Well, one, you just have to buy you pick one, and you just buy the same thing all the time, right? So it makes things a lot easier. You don't have to rebalance, and they're still very, very cost effective. Okay, and like I said, actually, asset allocation ETFs are actually what I use within my RESP. So for my kids' education, I use that because it's just so easy, and I like the automatic rebalancing, and the RESP is not such a huge amount, right? It's not gonna be as big as your retirement portfolio. That even though they're slightly more expensive, the amount is negligible, and so I'm happy paying like a very slightly higher fee just for the massive convenience and ease you get with asset allocation ETFs. And they are also great for RRSPs, TFSAs, and taxable accounts too. Again, I don't use them for my retirement accounts just because, well, one, they didn't exist when I started investing, and so that's kind of what I've already been doing. And when you have them split individually, like I said, it is slightly cheaper. You can have higher tax efficiency as well, but it's also a lot more work, right? And so you've got to decide, once your portfolio is big enough, do I want to keep doing asset allocation ETFs, or do I want to break them down individually? It's going to take me more time to manage, but I'm going to save some money, right? And then it's going to compound, and it's going to grow my portfolio even faster. So I decided to do the more like advanced route, and but not everyone does. And what's really interesting is, so I talked to a lot of people in the space, like bloggers and people that work for these different financial companies, who definitely have the ability to buy individual ETFs like what I do. They know how, they have the expertise, the portfolio is big enough to make it worth their while. And some of them still choose to just stick with asset allocation ETFs because they are so massively convenient, primarily, because of the rebalancing, right? And so for them, even though they could put in that extra work, they're just like, I don't want to be bothered with it. I don't want to have to rebalance using a spreadsheet. There's a great tool called Passive that actually rebalances for you, which I'll tell you about in a bit. But so I just want to really communicate that asset allocations are not just for the beginner investor. They're not just for someone getting started. There are people with massive portfolios that still use asset allocation ETFs because they're just extremely, extremely convenient. And so they're willing to pay those slightly higher fees to get that level of convenience. Okay, and again, do your own due diligence. All right, don't just take my word for it. Go do that, because again, I don't know your personal situation, but I find they were great, and that's like, these days when I talk to family and friends and they're just getting started, that's the way that I say, look, you really should get these on your radar, because they are pretty much the easiest way to do it. A lot of people will do like a robo advisor as well, but the asset allocation ETFs are like a robo advisor in a lot of ways, but they're a lot less expensive. So a robo advisor will do some additional things for you to make it, I would say, even easier, but that's not free, right? You are paying extra money for them to kind of hold your hand through the process a little bit more. And so with asset allocation ETFs, though, they're really giving robo advisors, I would say, a run for their money, because they do a lot of the hardest part about I would say is the rebalancing, right? People, I would assume, struggle with that part the most, because you actually have to know how to use spreadsheets, that kind of thing. And so robo advisors, when they came out, they're like, hey, we will do it all for you, right? So now it makes investing very accessible for the beginner investor, someone that doesn't want to mess around with spreadsheets. But then these asset allocation deals came along, and it's like, hey, we will also do this rebalancing thing for you automatically. You don't have to worry about it, and we're going to charge you less than what the robo advisors charge, right? And so to me, I was like, wow, this is incredible. Like, you just have to learn a little bit more than you do with the robo advisor, and you save massive amounts on the fees. And every dollar that you save in fees is a dollar that now is able to stay invested, that you're able to use to buy more ETFs. And now those are going to spit off dividends. They're going to spit off interest, which you can then take. You can then reinvest that to buy even more investments. And so you get that compounding snowball effect, right? So fees are very, very important. And here's some of the main providers considering. So Vanguard, iShares, BMO, Horizons. I would say those are the big four players in the space. They all have asset allocation ETFs. They are in that top ETFs guide that we talked about at the beginning of this presentation. So yeah, definitely, if you want to Google for example, Vanguard asset allocation ETFs, iShares asset allocation ETFs, BMO asset, right? If you do that, you'll be able to find their main pages, and I have the links as well. So maybe if you guys remind me, I will copy and paste them in the chat afterwards, because I have those actually ready to go, so that you can kind of read up more on them. But yeah, definitely something worth considering and worth getting on your radar. So the way these asset allocation ETFs typically work, here I have examples from the three different providers. So the one on the left is from Vanguard, the one on the top right is BMO, the one on the lower right is iShares. And so the way that you do is, step one is you figure out what you want your asset allocation to be, and there's different quizzes that you can do online. Vanguard's got a really good one, and it will actually tell you, based on different questions that you answer, what it thinks your asset allocation should be. So basically, you're split between stocks and bonds. And so once you know what that is, there are different ETFs with different allocations. So let's say you do the quiz, like I'll use the BMO as an BMO, or maybe I'll use the iShares because it's a bigger font here. So let's say you do the quiz, and we've got, one second, let me take a look here. This is fixed income, and this is equity, right? So this is your stock portion, and this is your fixed income portion, right? So let's say you do the quiz, and it says, hey, you should be 80% stocks, 20% bonds, based on the quiz that you gave, right? So then the one that you could pick is this one called XGROW, which is 80% equity, 20% fixed income. Another person who has a different risk tolerance will do that same quiz, and it might say, hey, actually you should be 60% equities, 40% fixed income, right? And so then it says that this one is more appropriate for them. And so all these different asset allocation ETFs, like BMO, for example, same kind of idea, right? They have their own. They're all very good, I would argue, and same kind of thing. You can see the different fixed income versus equities allocation for each one of them. So BMO has more than just these three. Vanguard has more than these three, right? I'm just giving you sort of a screenshot from their site to show you basically how they work, right? And this is why you can just buy one ETF, which is basically a basket, and that contains the right ETFs within it that fits the asset allocation that you want. So I'm kind of going over this fast because there's just so much to cover, and I'm chatty. But if I went over too fast and you want more clarification, let me know, and I can go into more details. We'll have the Q&A after, and I'm happy to stay on to help if you guys want any sort of clarification there. So more asset allocation ETF advantages. You can just hold one for your entire portfolio, which I already mentioned. It's as simple as buying a stock. It's very easy. You don't need someone to do it for you. If you've ever bought a stock, it's the same thing. You just put in the ticker. Each one of them has their own ticker. You put that in and you can buy it just like you would a stock. And if you don't know how to actually buy it, I mean, there's lots of resources available on my site. I've got resources on how to actually do it. I know Enriched Academy, I think, has resources as well. Aaron can maybe jump in on that a bit later. But yeah, there's definitely a wealth of information on how to do it. It's very, very easy to do. The automatic rebalancing I've already mentioned, a very key point that I truly believe holds a lot of investors back, because not everyone is a spreadsheet nerd like myself, and I get that. I'm just wired in a different way, and so that's a really, really huge advantage that really I would say this just destroys that barrier that was keeping people from being DIY investors, which is awesome. And you can always switch to a more conservative allocation. So in the case of an RESP, when you're saving for your child's education, one common practice is that once the kid gets closer to being in the post-secondary, you change the allocation to be a little bit more conservative. So you lower the stock allocation a bit, you increase the bond allocation, right? And then the same thing for retirement accounts, so RSP, TFSA, taxable accounts. A lot of times as someone gets closer to retirement, they're like, okay, we need a little bit more sort of stability. We don't want things to fluctuate as much because we're actually going to be using that money. We don't want to be withdrawing the money after, like, right after a giant crash, and our portfolio's fallen 30%, let's say, and now we're taking money out. We don't want to do that. So let's have a little bit more bonds in there to stabilize, right? And so you can basically switch to different asset allocation ETFs, potentially go more conservative as your kid's getting closer to post-secondary in the case of the RESP, or as you're getting closer to retirement and never actually working again, as is the case with your RSP, your TFSA. Yeah, so I hope that makes sense. All right, lesson 3, take advantage of the RESP. So this is applicable to anybody that has kids already or someone that may have kids in the future. So all the tips so far have been pretty much, I would say, for everyone. This is the only one that's the tip that's specifically for parents, but it's such a big one that it's really worth highlighting. So the big reason why you want to take advantage of the RESP is you can receive up to $500 in grants per year per kid from the government to pay for their education, which is awesome. Like, I consider it free money. Some will argue, well, it's not really free because you've got to put some money in yourself in order to get that. Fair enough, but you're still getting $500 that you didn't have to work for, basically, right? And that you can now invest towards your kids' education, and that's every year per kid. So it's awesome. There's also additional CESG, which is anywhere from $50 or $100 per year if you're sort of on that lower income side. There's also the Canada Learning Bond, where, in addition to that 500, you could get up to another $2,000 total, from that. So those are the A and B that you see there. Those are the options for more lower income families, but pretty much everyone can get this $500 main grant per year as a CESG. It's what it's called. Okay. So no matter what your income level, you can basically get it at least at $500. And so really what you're getting is an instant 20% return on your money. I think that's the best way to look at it. So the way that it works is, and I'll give you a real life example of what I actually do every year with my kids. But essentially you put in $2,500 per year. And when you do that, the government's going to give you 20% of that in addition, right? It's going to give you that. So it's going to give you $500 because 20% of 2,500 is $500. And so as long as you're putting in 2,500, you're getting the 500 free, essentially, from the government. Now, you might say, well, I don't have $2,500 to put in, and that's okay. You're still going to get something. You're going to get 20% of whatever it is that you put in, right? So if you're putting in less than 2,500, it's going to be whatever that amount is times 20%, and that's the grant that you're going to get. So you're not going to get the full 500, you're going to get a bit less. But 2,500, I would say, is the sweet spot, because that's how you get the maximum grant. That's how you get the max $500 per year per kid. Okay, so I'll give you a real life example of how I actually do it. So I have 2 children. Every year, so in January, I'm like, all right, the year has started. Let's top up their RESP because I can get that grant again, right? Every year you can get that 500 per kid grant. And so what I do is I put in 2,500 for the one kid, I put 2,500 in for the other kid. And then, as you know, if you're already investing, usually it takes some time for the money to actually arrive in your account, like in your trading accounts. Like I'm with Questrade, for example, it might take a few days for it to actually arrive. And so what I do, and again, this is like in real life, what I do all the time annually, is I use a tool called Passive, and I actually have a link here if you want to check them out. What they do a whole bunch of really cool things. The one thing that I use them for a lot, in addition to like the reporting and rebalancing, is they will actually send you an email when that money is available. So after I put in that 2,500 per kid, I don't need to go check every day or every few days to see if that money has arrived. Passive will actually email me to say, hey, Cornell, that money's now arrived in Questrade. It's ready to go. And so then I go, okay, awesome, thanks. Delete the email, log into Questrade, and then I buy the investment. So in my case, I buy the asset allocation ETF, or I buy one asset, multiple units of the same asset allocation ETF. And then basically I'm done with that piece for now. What happens next is the grant can actually, you get the grant later. So it can take somewhere like 8 weeks, even a bit more, sometimes less, for the grant to actually arrive from the government. So that $500 per kid. And so again, in my case, after I've invested that initial 2,500 each, I log out, I live my life, and then eventually I get an email from Passive saying, hey, Cornell, basically the $500 per kid has now arrived in your account from the government and it's ready to invest. So I say, awesome, thank you, delete the email, log into Questrade, and then I see that it's sitting there as cash, that free basically $500, and I take that for each kid, and then I invest it into the asset allocation ETF that I choose. So that is basically the process. What I will say real quick about passive is that you can actually get it for free, but there's like specific way you have to do it. So I have a page on my site. So it's bulletofcanada.ca/passive, which is just passive without the E. And there it'll actually show you how to get it. Because the way that they have it set up is that it's free, but they also have this premium account. But if you're a Questrade user, and you can sign up to Questrade for free as well, and that's who I use, you will actually be able to get the premium account with all these extra really cool features for free. But again, there's a specific like process you have to follow. So on this page that I built, it basically shows you step by step how to get the whole service essentially for free that you can use. And like I said, I use it all the time. It's amazing. I've had them on my show. They're on the summit again. It's great because I mean they give you these notifications, but they've got amazing reporting functionality that I use all the time just to see how my portfolio is doing as a whole. Because we have so many different accounts, and so I can actually see them all in one spot in passive. And if you do want to do individual ETFs, they will actually rebalance it for you, so you don't even have to do the spreadsheet thing anymore. Anyways, it's really cool. I definitely think you should check it out. I use it a lot, and I'm a big fan, and I like to support these guys every chance I get because they're fantastic and it's free. So why not? That's basically what I do every year, and I just rinse and repeat every single year to get that $500 grant. While it's in the RESP, the invested money grows. They're tax-free, like an RRSP. So when you've got these investments, for example, the ones I do, every quarter they will issue dividends or interest. So that is going to show up in your account as cash. And so then you're able to invest that to basically get a compounding effect once again. The government does not tax it at that time. So if you get, let's say, $100 in dividends, you can take that entire 100 amount within your RESP and you can just reinvest it to buy more, right? So now you're basically getting that compounding effect, right? Where you bought the initial investments, those spit off some income for you. You then take that income, reinvest it to buy more. Now you've got a bigger pot. Now your dividends are going to be even bigger. Then again, you take those dividends, use them to buy even more. Again, so the pot keeps growing and growing, and you get that compounding effect. And yeah, I mean, there's if you do things right and the markets are doing good and you actually get a good rate of return, I mean, you could, I crunched the numbers. I mean, you could actually get like close to $100,000 portfolio for your RESP, which is basically clearly going to cover your kid, I would argue, for education expenses, by doing things in this way. So again, it's going to vary depending on what you choose to invest in and how you do it and all that. But the bottom line is that this is definitely worth your attention, because I hear a lot of people stressed out about cost of education is going up. How am I going to pay for it? How's my kid going to pay for it? They're going to be in debt for decades afterwards. How do we do this? Well, an RESP is a really, really great tool for that. I already mentioned there's no tax on dividends, and you get that tax-free compounding. So that part I already mentioned. Now, there is one landmine, I will say, when it comes to RESPs, because there is multiple right ways to do it. And I would argue there is one wrong way to do it. And the wrong way can cost you thousands and thousands of dollars. And I actually have family really close to me that got taken advantage of this and made this mistake. And so I really want to make sure this doesn't happen to you, because RESPs are a great tool, but you've got to actually use it properly. And so so this is a sensitive subject, because like I said, we've had family that got hit by this pretty hard, and so I do want to warn other people. So the question is, why do I manage the RESP myself using Questrade instead of signing up for an RESP group plan or a scholarship trust? So there are companies out there, they do these RESP group plans that are called scholarship trust, and I'm not going to paint them with too broad of a brushstroke, right? So I'm not going to say they're all bad and they're evil. I'm not going to generalize like that. I'm sure there are some good ones out there that have their good, or I hope there are some good ones out there that have, that have their they're ethical and do things good and are nice or whatever. But there are definitely some really bad apples. And if you Google this, or if you Google things like RESP group plan lawsuit, things like it's actually been on the news, people suing them. There's one case, for example, where there was one company, or there was an employee at a hospital who basically, I guess, stole contact information of all the new parents, because people are giving birth at a hospital. He sold that information to one of these companies, and then this company used that stolen information to then send out their sales force to try to persuade people to basically sign up with their RESP group plan. So like I'm not saying everyone's like that, but there's definitely some really sketchy things that have happened in this industry in the past, and so you've really got to have your guard up. And so what these RESP group plans do is they'll basically say, look, we'll take care of all of this for you. Okay, you make the payments. Why wouldn't you want free money from the government, right? But yeah, hey, it's complicated, right? So we'll take care of all of this for you. We'll do it. Just give us the money. We'll take care of the investment piece. We'll make sure you get the grant when the kid's ready to go to school. We'll help you with that whole process. Everything will be nice, right? And so that's kind of their pitch. And I know when I became a parent, somehow they got my phone number. I think it was because you can, as a parent, you can sign up for those things where you get like free stuff, like free diapers or free whatever. But then of course, nothing's really free, right? Your information gets sold to other people. And so I remember getting calls from some of these companies saying, hey, why wouldn't you want this free money from the government? We will help you do it, right? But Jenny, if you do it yourself, like what I recommend you do, and what I personally do, you are going to get lower fees, because again, the people that do that, they don't work for free. They're not just going to help you out of the goodness of their own heart. They are going to their fees are going to be much lower if you actually do it yourself, like by buying asset allocation ETFs, for example, which is what I do. You will have much greater control over your investments. So if you have your RESP, whether it's Questrade or Qtrade, or one of the discount brokerages, for example, you can pick what you want to have in your RESP. You have much control, and you can pick something that is going to be good for your particular situation. Whereas these places, they're obviously going to push their own investing products. Those products tend to have much higher fees, so you're going to be paying a lot more. And again, every dollar that you spend in fees is a dollar that's not going towards your kid's education. It's a dollar that's not being compounded to grow, right? So why wouldn't you want more control over your investments? Typically, there's also fewer restrictions on how the money can be used if you do it yourself. So if you look at the actual list from the government of what's eligible for RESP, it's actually a very generous list. There are a lot of programs that are eligible for. If you look at that list from some of these companies, you'll notice they are not identical. There are things that are actually eligible for if you do it yourself, versus some of these companies, they will not have some of those things there, some of those programs. And so my kids are 3 and 7. I don't know what they're going to want to do when they grow up, right? I have no idea. So I want to make sure, of course, that they are eligible for the most amount of programs possible when it comes to the RESP, right? I don't want to be restricted in that area. What if they decide to do something and then the company says, oh, sorry, that wasn't on our list, so too bad, right? So that's a really critical component. And the big thing is that generally, you're not tied to a strict So when you sign with these RESP group plans, there's a contract that you've got to sign, right? And there are very steep penalties typically if you miss a payment or you decide to leave the plan. So this is what happened to one of our family members, is that their son went to university, they had the RESP, and then they went there for a certain period of time and they decided, you know what, this program is not for me. I don't think university is for me. I'm going to switch to this college program instead. Okay, great. Sounds good, right? So we could just use our RESP money for that instead. Sounds reasonable, right? No. According to this particular company and the rules that they had in place, they basically said, no, this doesn't comply with our rules. And so what happened is they literally lost. So I talked to the family member of mine. They literally lost all of the gains that they have gained over those years of investing in fees. All right. So imagine you're saving for your RESP, you're putting that 2,500 away, you're getting the 500 grand, you're investing it, that money is growing and growing, and it's great. You're going to have enough to pay for your kid's education. Wonderful. And then something changes that's totally out of your control. Your kid decides to change a program or whatever, and you say, okay, I'm going to leave this plan because you're not letting me use the money for it. And they say, okay, fine, you can leave, but here's the fees we're going to charge you. And these fees are, it can be in the thousands and thousands and thousands of dollars, like it was in this case, to the point where this individual in my family said, "Well, we literally lost all our growth to these fees that they charged, right? Like they felt like it was the scam, right? So again, I'm not saying they're all like this. Obviously do your due diligence. If you don't do, if you still want to do like an RESP group plan or whatever, okay, that's your decision, but just have your guard up, read the fine print, because there are definitely some really, really bad apples out there. And so I just want you to, well, ideally just do it yourself for all the reasons I already explained. But if you're not going to do it yourself, at least be extremely careful and don't get talked into by this, like, sales pitches, that kind of a thing. And here's just some quick government resources for the RESP. So the links are really long, so I just made a short version of them on my site, which will automatically redirect you to the government site. The first one is some of these government sites, they don't word it in a way that's easy for a regular person like us to understand. So the second one link I would say is a lot better. So if you do want to read more on the RESP and how it works, check out that link. You'll learn an absolute ton on the second one. But yeah, again, hopefully this helped you a fair bit as well. Okay, so that's we're on our second last one. Arian, I hope we're good for time. If we're not, let me know. Maybe like I can cut one shorter, talk even faster or something. So lesson 4 is diversification is key. So like I think I already said before, I was invited by BMO to do a presentation to some of their customers, and this is one of the slides they actually put together, and it's really, really informative and useful, and really helps illustrate why diversification is key. So again, big thanks to BMO for doing that. And yeah, they have some great asset allocation ETFs as well, and other core ETFs as well. So big kind of shout out to them, and thank you for letting me use this. So what this chart shows you is what the highest performing investments were for different years. And so I'll use the US, for example, has had a really good run lately. So the US, so here we got on the right side, we've got international equities, US equities, Canadian equities, Canadian bonds, cash, global bonds, European emerging markets, and a balanced portfolio. So out of all these, which ones perform better, right? So we've got the highest returns are at the top, the lowest are at the lowest returns for that year are at the bottom, right? So for example, in 2019, the US did the best. It had this kind of a return, and so cash did the worst. It had a 1.6% return. And then we've got the ones in between. So the higher you are on the list, the higher the returns were. And so there's a few key takeaways here. One, and I'll use emerging markets as an example. So emerging markets, and hopefully you can see my mouse, is EM. It's the purple one. The first lesson is that you'll notice from year to year, the rank can really change drastically. So for example, in 2010, emerging markets had the second highest return. In 2011, they had the lowest return, minus 16%. 2012, they had the second highest, right? 2017, 2020, they actually had the highest, right? So again, because all these fluctuate so much, you don't want to have all your eggs in one basket. And Canada is very famous for having a very big home country bias. There's a lot of Canadians who hold an enormous proportion of their portfolio in just Canadian equities, right? And so this is kind of a thing I want to say, look, please consider having a more globally diversified portfolio. There are quite a few countries where investors got in really bad shape because they had all their money in just one country. Japan is the really famous one, right? Where, they had some really, really horrible returns over the years. And so if people that had all their investments in there that live in Japan got hurt quite severely. You don't want to just only be in Canada, for example, because you can see how much the ranks can go. You can have a great year one year, have a really, really horrible year the other year. So that's one thing that I really want to encourage you. Make sure you have a nice diversified portfolio. And again, this kind of goes back to why I really like the asset allocation ETFs, because you pick one ETF and it takes care of this piece for you. So it's really good from that angle. Okay, so I just want to encourage you. I'm not saying those are going to be perfect for you. I just really want you to go and do your own research, go down that rabbit hole, learn more about it, because it is at the very least something you should have on your radar and you should at least consider. The other key lesson from this chart is that you don't want to just make a rash decision and swear off a particular investing type. So for example, let's say it's 2011 and you start investing at that time, and emerging markets have a horrible year, right? Minus 16%. And you're like, oh my goodness, US did so much better. Emerging markets horrible. You know what? I'm going to swear off emerging markets. I'm never going to touch them again. These are garbage, right? Let's say you made that quick assumption, right? And then what happens next year? Wow, they're in second place in terms of the returns. 2017, they've got the highest returns. 2020, they've got the highest returns, right? And so this is just another thing, is don't just look at 1 year and make rash decisions based on that, because again, what could be a bad year one time could be, like US has been doing great, but hey, maybe in the next 5 years, things go down, right? Who knows? We don't know. Nobody knows, right? And so that's why it's so key to have a diversified portfolio. Okay, and this is the very, very last one. Hopefully we're still okay for time. I'll try to go through it quickly. This was a really interesting insight. So I was actually asked to teach RESPs by Questrade to their clients. And so we put a presentation together, and this is one of the things that sort of insights that they had, some numbers that they crunched, which I thought was a really good insight that I really wanted to share with you as well from that presentation. And so here what we have, and this really just shows you how it's important to start investing earlier. And the earlier you start, the easier it is to actually have a much significant portfolio over time. So there are two scenarios, okay? Scenario one is this first column, scenario two is the second column. So what you do in scenario one is, let's say you put in your child is born, you put in $6,750 and you invest that right in the market. So in this case, they were using an 8% estimated rate of return annually. The child retires at 65. You make zero contributions. So just to be clear, what we're doing here, we're putting in a $6,750 amount when they're born, and then we put nothing else after at all into this account. We just leave it alone. We don't touch it. At 65, that's when we go back and we say, okay, let's see what happened to the account. So if you did that, so you're adding zero money over the years, you would have ended up at an 8% return with a portfolio of over $1 million. So your child is now a millionaire because just in 1 year when they were born, you put in the $6,750. So your total contributions to get this $1 million was $6,750. That's a pretty sweet deal. And obviously that really shows the power of compounding. Now, let's look at scenario two. Scenario two is your child is born, you do nothing, right? Still getting 8% return, years until retirement 65, same as before. But then you start, or the child in this case, which starts investing when they hit 30, right? And I think this is a reasonable assumption, right? Let's say you're at 30 years old. When you're in your 20s, okay, you're fresh out of school, maybe you're saving up for a wedding or for a house, whatever the case may be. Retirement maybe isn't really on your radar yet. So let's say the child hits 30 years old, and they're like, okay, now I really got to start actually saving for my retirement. Okay, so at age 30, they invest $5,803 towards the retirement, and they do that every single year. So it's not a one-time payment like in the previous scenario. Every year, starting at age 30, they put in $5,803 investing it in the same way as in the other scenario. By the time they hit 65, they also now have $1 million portfolio based on all these assumptions, right? So this is pretty fascinating because look, their portfolio is almost the same as scenario one. The difference, however, is that because they're putting in this amount starting at age 30 instead of starting at age 0, they've actually put in $203,000 of their own money in order to get to this 1 million, in order to basically be a millionaire, have this $1 million portfolio. Whereas in the first scenario, instead of starting at age 30, they started out right when the kid was born, and they only put in that initial 6750, and they also ended up with an almost identical $1 million portfolio, right? So this really goes to show what a giant difference starting early does, as opposed to waiting and making excuses. Oh, I'll invest later, and just kind of putting that on the back burner because life happens and things happen. So we're just going to wait and wait and wait. Look how much more you've had to put in to get to that exact same amount just because you decided to start later. So that's, I think, something really critical that we have to wrap our head around. So yeah, you can do just one deposit now versus 35 payments every single year later. Which one would you rather do? Again, power of compounding. Do you deposit the $6,750 once, or do you deposit $203,000 over 35 years? Which one would you rather do, right? And which choice will impact your lifestyle more, right? Pretty sure we can all agree $6,750 for 1 year is gonna impact our day-to-day lifestyle a lot less than putting in $203,000 over a 35-year time span. All right. Obviously, there are inflation considerations here, so I don't want to make it sound like myself or Enriched Academy is saying, oh yeah, all you need is $1 million 65 years from now, and you're fine to retire. So that is not the point of this. We're just saying all I'm trying to illustrate here is really the power of compounding, the power of starting earlier, the power of staying invested in the market, and how drastically that can grow, how you can actually reach 1 million fairly reasonably over time. Obviously, $1,000 65 years from, oh sorry, $1 million 65 years from now is not going to have the same purchasing power as it does today. But again, that's not the, that's not the point here. I'm not saying we're all trying to get to 1 million. I'm just saying really consider these implications of not getting started early, because catching up gets really, really hard the longer you wait. So bottom line, much easier to begin saving and investing now instead of waiting and having to do these catch-up deposits later. All right, we got through it. So next actions, and then we're going to jump into the Q&A. So again, join me at this year's Canadian Financial Summit. I got a special link here for everybody with Enriched Academy. And you're watching this round as part of Enriched Academy, but feel free to send this link to your friends, coworkers, whatever. Like I said, this link, you can get the tickets for free. It's CanadianFinancialSummit.com/EA free. So you just go there now. Again, it's next week, so definitely don't leave this until later because the summit will be over. So you definitely want to do it now. And again, check out my podcast. So all the interviews are also available for free. If you are a podcast listener and you already have your favorite podcast app, just search Build Wealth Canada there. It should show up right at the top. It should be on all the major podcasting platforms. And if you are not a big podcast listener, but you want to check it out, you can also just go to my site, which is buildwealthcanada.ca. There's a lot of great free resources on there. I'd say like 95% of the content on the site is completely free, really good education. And you can actually download all the episodes there too for free. You can stream them all for free. So it's like many hours of really high quality education with some of the top experts in Canada that you can basically get for free, and you'll learn an absolute ton. So sign up for the summit. I hope you check out the show as well. And that's it. That's all I got. I'm ready for the Q&A. I hope that was helpful. Hopefully, I'll be happy to come back next year and share some 5 new lessons that I've learned from the experts over the years. I hope you guys enjoyed that.
Awesome job, Cornell. Thank you so much for that. That was incredible. Really well done. Anne says, love your podcasts. They're excellent. Adele's like, great presentation, Cornell. Guys, everyone in the questions box, just please give a warm thank you to Cornell for putting this together for us, spending an hour and sharing his knowledge. Just put in thank you in the questions box. And if you have any questions, let's get right into it. So Cindy asked, Cornell, can you have 2 RESPs? I'm a new grandma, I want to start, and what if the parents want to do it also?
Yeah, there is a way to have, you can have more than one RESP. You are going to receive the grant in only one of them. So that's just kind of one thing to consider. Like if you have one with one bank or institution and one with another, the grant's only going to come to one. Like you're obviously not going to get 1,000 instead of 500, right? Like obviously there's limits on that. So you can do that. You can, as a grandma, you are also allowed to contribute to basically contribute to your child's RESP. You can definitely do that. One little caveat about that is there's actually 2 different types of RESPs. There's the individual one, and then there's a family one where it's like a pool of money. So like I have a family one because I have 2 kids, right? So we just have one RESP, but it's a family account, and so all the money goes in there for both kids. If you're a grandma, because it's not your, it's not your child directly, they would need to have an individual RESP account for that. If you have questions about that and the actual implementation of that, what I do recommend, and this actually is a great question, it came up when I did that RESP training to Questrade's customers yesterday, actually is when it was. And yeah, just if you are with Questrade, you can go on there and you can actually ask them in their chat or call them, and just to make sure that you're setting it up correctly so that you're able to contribute to it as a grandparent. And if you're not with Questrade, if you're another provider, I'm sure they would be able to assist you as well in having it all set up correctly. I hope I answered that okay. Hope that answers your question.
That was great. You're getting so many thank yous, which is amazing.
Awesome. Thanks, guys.
Okay, let's see. Okay, do you have to open a separate RESP account per child? You kind of answered that one. What is the best asset allocation ETF for investing in a kid's RESP? That's a good one.
Yeah, so that's a tough one. And again, I got to be careful here, right? Because I'm not allowed to say like, hey, this is the best ETF ever. You should get this one. Because I don't know your situation, right? And I don't know your risk tolerance. Like if you do 100% equity one, and like when we had COVID, right? When we had that initial big crash, Things have really recovered nicely since then. But during that time, right, it was like a 30% drop if you're an equity investor, right? So are you able to handle that? Are you able to ride it out? Or would you have panicked and sold and swore off investing because your thing dropped 30%, versus if you actually waited, you would be up and you'd be having incredible returns, right? So we got to be really careful about saying like, here is the one ETF that is incredible and amazing, and this is the only one you should get. So I would say the key thing, okay, so typical, yes, I gotta be careful how I word this, right? So the different asset allocation ETFs from the different providers are good. I haven't heard anything negative about any particular one. So like I said, BMO is a very big one. They've got some good ones. iShares, Vanguard as well. Horizons is a bit different with like the way that they structure it. They do have like a swap-based structure, which is kind of a little bit more advanced. So if you are interested in that, you can research that more on your own. But I would say there's nothing with like the three providers that I would say, oh, like definitely stay away from this one. But then you get into the questions, like I would say they're all good, and I would personally feel comfortable putting money in any one of them for RESP. So then we get into the question of, okay, if that's the case, which one do you invest within, right? And so like I showed in the charts, there's different allocations, right? So there's ones that are very conservative, like let's say 50% bonds, 50% stocks. There's others that are 100% equity. And so to answer your question, the one that's a good fit for me is I actually do the 100% equity one, because my kids are 3 and 7, so they still have many more years to go before they start their post-secondary education. Usually when there is a market correction or crash, typically most crashes do recover within 2 years. Historically, that's been the case. Obviously, there's no guarantee that that's going to happen forever in the future. Nobody knows. There's no guarantees in the stock market. But typically, at least if you look at historical data, things do recover within a 2-year period, right? And so if my kids are 3 and 7, they got way many years before they start post-secondary. So I am happy and content with a 100% equity allocation asset allocation ETF for them, and that's pretty much all that I buy. Once they get a bit closer, like they're like a year or two away, maybe then I'll do a little bit more. But then you're kind of a bit more towards bonds. But even then, I'm still not fully decided on that, because again, if most markets do recover within 2 years, then let's say the kids start school and okay, there's a bad year, but then there might be a really good recovery, right? So yeah, you could get unlucky. There's risks if you stay with 100% equity, obviously. But I would say, yeah, if your kids are younger, so a lot of it basically has to do with your risk tolerance, right? How much can you handle it? Can you handle the fluctuations? Are you going to be able to sleep at night, right? So when the markets fell 30% and my RESP fell 30%, right? I was like, okay, like this is what happens. We know these things happen. There's going to be another 2008 situation in the future. We have market corrections all the time. Historically, it's always recovered. So I personally did not lose sleep over that. And now the RESP is higher than ever because we've had that really strong recovery, right? So for me, that was a good fit, because you have higher expected returns the higher you go on the stock, on the equity allocation, right? So that's why I go 100%. But again, that's not for everyone. Like I have family members who I know if their portfolio fell 30%, they would be calling me, freaking out, sweating, have trouble sleeping, right? So again, you've got to sort of learn yourself and reflect, can you handle these kinds of fluctuations? And then, so I would say, like, my general advice is go as high equity as you can go without getting to that point where this is now a stressor for you. You know what I mean? Where you're checking the RESP every day because you're worried about the day-to-day fluctuations. So I hope that answers the question. I'm, trying to give you there is no one silver bullet, like I often say, but that is the sort of thought process that I recommend you have when deciding what the best option is for you. All right, I'm ready for more. Aaron's probably just looking through all the different ones.
Awesome, Cornell. Yeah. So Nancy asked a good one. She said, "Can you invest in an asset allocation ETF through Wealthsimple or Questrade, or do we need to go right through Vanguard?" And I can help answer that one. I know Questrade you can. I invest in one of the asset allocation ETFs. And yeah, Questrade is so easy, right? It's like almost like buying a regular ETF for a stock. Wealthsimple, can you do that through Wealth Trade? I don't know.
Yeah, to my knowledge, you cannot, because the way that Wealthsimple and the other robo advisors, like the way they do it, so I kind of view robo advisors as kind of like an asset allocation ETF in a way, right?
Yeah.
So with a like if you look at a Wealthsimple or some of the other robo advisors, they basically already have their own kind of portfolio that they're going to put you in. So they're going to make you do a quiz to find out what your asset allocation should be. So they're going to try to estimate what your risk tolerance is. So can you handle that 30% drop, 40% drop, that kind of thing. And then they're going to say, okay, based on this quiz, we think you should have this much in stocks and this much in bonds. And so we're going to put you in this portfolio. And it's going to be, and I'm not knocking robo advisors at all. I just feel there's a more cost effective way of doing things, right?
Yeah.
So then they're going to put you in a portfolio that they've created, and it's going to be a nice globally diversified portfolio, awesome. And then you're good. So you don't have to worry about the whole asset allocation ETF piece at all. You're just basically pumping money into Wealthsimple, for example, at that point,
Yeah.
and they're pumping the portfolio. So it's almost like they are kind of like an asset allocation ETF, except it's not called that because they're a robo advisor. So they're buying like those individual ETFs instead. So I would say asset allocation ETFs are a competitor to the robo advisors. They're a competitor to like the Wealthsimples of the
Hmm.
world, because when you buy the asset allocation ETF, you're buying a basket of ETFs. So there's individual ETFs within that asset allocation ETF. And so like Wealthsimple, they have their individual ETFs in there as well, right? So they're like the basket versus an asset allocation ETF. They're its own, they are their own basket. So you're buying asset allocation ETF instead to basically save a lot on fees. You still have to figure out what asset allocation you want. And so, like I said, there are, if you search like asset allocation quiz Vanguard has a really, really good one that you can take. And it's basically the same kind of test that Wealthsimple would have you do to help you figure out what your allocation is. There was a second part to that question. Oh yeah, how do you buy it? Yeah, so you would buy the asset allocation ETF through a brokerage. So like so Questrade is an example of one. Qtrade's another example of one. If you're already with like a major bank, they usually have a discount brokerage arm as well. Like BMO would have one, TD would have one, RBC would have one, right? So there's lots of different ones that you can do. You do not actually buy them directly through iShares or directly through Vanguard or directly through. Like I guess you could buy directly through BMO because they have a discount brokerage. I hope that answers that question. Let me know if I hopefully I didn't make you more confused, but that's how it works.
Awesome. No, great. Well, as
So
a
you don't go on
couple,
the iShares website and then buy it right from there. That's
yeah,
not what you do. You have Questrade first, for example, and then you find out what ticker you want, right? What ETF you want, and then you buy that on Questrade, for example.
absolutely. How are you for time, Cornell?
Oh, I'm good. I'm good.
Okay.
Yep.
We'll try to, respect Cornell's time for sure, and we'll answer a couple more questions here. Gladys asked, am I able to cancel my RESP from RBC and switch it to something like Questrade without penalties?
You can definitely do a switch for sure. We got that question actually yesterday on the Questrade webinar that I did. So there definitely is a way to do it. There are sometimes providers you will be charged fees for making the switch, but I know Questrade specifically, they will actually reimburse you those fees. So that's something to no, because that's huge. I can't remember what they will reimburse up to, but I mean, obviously, someone like Questrade, they want your business, right? So they don't want like some fee that RBC or whoever charges you to prevent you from making the switch if you want to do the switch. So as far as like a next action goes, if you did want to switch to, let's say, Questrade for an example, then I would definitely go on the Questrade site. They have, there's like a chat thing. You can chat with someone live there, or you can call them, and I would tell them exactly that. Look, I'm with whoever. I would like to switch over to Questrade. I'm concerned about any fees that they might charge me for switching. I heard you guys reimburse the fees that can be there. Can you take me through the correct process so that it goes, smoothly, that kind of a thing, right? And then they will take care of it for you. So like I've been with Questrade since day one personally, but I've helped family and friends with this sort of switching process, and they have had a good experience, which makes sense because obviously, whether you're dealing with Questrade or someone else, in my case, Questrade, they obviously want your business, right? And so they will try their best to make it as easy for you to do, that switch, right? So, yeah, so I hope that answers that question. But yeah, definitely, if you're switching away from someone, ask them what the fees are. Right, like I'm going to be switching on Questrade. What are the fees, or whoever you're switching to? Get that number, and then when you're talking to, let's say, Questrade, you can say, "Hey, I found out that the fees are going to be X for switching. Can you guys reimburse me?" That kind of a thing. Yeah.
Amazing. Heidi asked, hey, do you have the links for the asset allocation ETFs you mentioned?
Yes.
Great presentation. Heidi, I will actually recommend, I'll put that in there,
Sure.
Cornell, but I would recommend that when you join the summit, watch that one video with Cornell and the Money Sense team actually going through and analyzing these different ETFs, because a list is great, but when you can actually understand what you're looking at, you're able to make an educated decision. And even the decision that you make, you have confidence because you know why you're making that decision. So many people buy stocks and ETFs and they don't know why they're buying it. And if you don't know why you're buying it, that's crazy, right? Like you need to understand the ins and outs of that ETF. So the list is great. Hey, I love lists, right? They make our lives easy. But if you really want to take your education and your investing to the next level, you need to understand the ETFs that you're investing in. So I'm so excited for that session,
Awesome.
Cornell, where you're going to explain it, but I will send that in the meantime to everyone. Which,
Sounds
is
good.
it the Money Sense one, Cornell? Is that the all-in-one ETF Money Sense list?
Are you talking about the ones if you want to read up on the specific asset allocation ETFs? Is that
Yes.
what you're about here? You know what I'll do? Here, give me a sec. I'm just gonna. It's in the notes for the slides. Here, I'm
Okay.
just gonna copy and paste. Oh, here we go. They're right here. You should be able to see my screen. Okay, there we go. Give me a sec here. There we go. And I'm just gonna go to the chat here. Okay, there we go. So yeah, so I've actually gone through, like I went to each of the main providers and I thought, okay, what is a good page that explains their asset allocation ETFs nicely? And so I found a good one for each one, and that's what these links are right here. And I will say, like, I don't sell asset allocation ETFs. I have no like horse in the race. So you know, this is I don't work for some company that sells them, right? This is just, look, this is what I am hearing from the different experts who I trust and respect. This is what I literally use for our RESP. If my portfolio was smaller, like if I was just getting started, and if I wasn't like, if I didn't enjoy the spreadsheets and stuff like that, I'll probably be doing asset allocation ETFs for my retirement accounts as well. You know what I mean? So I'm just a fan of what this is. I think it makes investing very accessible to Canadians. And like I said, it's what I suggest strongly to friends and family that are just getting started. And like I said, even people who have large portfolios, who are really close to retirement, you know, that it's still something to consider, because you do get that massive convenience, you know, with the rebalancing and just having everything in one ETF. Yeah, so I just want to point that out. Like I'm not like some ETF sales person. I don't sell investments at all. So I
Awesome.
just do education, and that's all. Well, one quick thing I'll mention, Arian, because we had that question about switching to Questrade.
Yeah.
Whenever, if you are with a provider, whether like whoever that may be, and if you're holding some of those, you know, high fee mutual funds, some of them might have deferred sales charges, which is something they might charge you if you decide to sell that high fee mutual fund. So that's also just something to have on your radar. If you did buy mutual funds in the past, and you do want to switch out from them, you want to, let's say, sell them and buy asset allocation ETFs or buy individual ETFs, you do want to ask that provider who you bought it from, saying, hey, if I sell these now because I want to do ETF, they're going to try to persuade you not to do it, obviously, because they want the high fees, you know, but just ask, what are the fees, if any, that I will be charged if I make the switch? And so that's also something that you want to kind of know about, if that fits your particular situation.
Amazing. Mark
Yeah.
said, hey, thanks for this, Mark, because Questrade will cover your transfer fee up to $150 per Questrade account. I just talked to them this morning about this
Awesome.
exact one. That's great.
Awesome. Thank you. Thank you. Yeah, I forgot what the exact amount was from our presentation. So I appreciate you. Thanks for chiming in and letting us know. Yeah, and
Yeah.
I think when I talked to Questrade about it, they said, yeah, like typically the banks, the amount that they will charge for the switch is less than that. So I think what Questrade's going for there is they want to cover that whole entire cost for you, so that's not the reason, so that isn't a reason why you don't switch, because, oh, I don't want to pay this $100 or whatever, right? So they're trying to make it kind of easy for you.
Awesome. And Cornell, those links are in the chat box. If you're watching this on YouTube, it will be in the description. So click on the description and you can have access to that. Okay, last question here. I actually like this question a lot, and let me find it. So this person was basically asking Nancy, what is the process to invest money? But you want to use the investment returns as yearly income while not touching the principal. So maybe this is someone that's getting closer to retirement. They want some more passive income from their investments. What would you recommend to do there?
Oh, like what would the process be for taking some money out of your investments to
Hmm.
live off of without actually touching the principal? In other words, the actual
Yes.
amount that you initially invested, right? Yeah, so we've actually gone through this in real life because yeah, my kind of story has been interesting, right? Because we hit our financial independence number at 32. We quit both my wife and I quit our jobs. She became a full-time stay-at-home mom. I switched to semi-retirement, did that for 2 years, then I'm like, okay, let's just try this full retirement thing. That sounds like fun. Tried that, and then 6 months later, I was like, this is very unfulfilling to be this unproductive. And so I actually like, well, what if I actually did productive work, but like for myself? So that's why like the summit, I got involved in the summit, and then the podcast has been running that kind of. So it's been a kind of a funny self-discovery thing, right? Going from like full-time work to semi-retirement to full retirement and then back to semi-retirement, and now I feel like okay, we're in a good space, you know what I mean? So anyways, the reason I bring it up is because yeah, we have actually done that where during the semi-retirement and full retirement especially, yeah, we were actually living off our or are living off the portfolio, right? So the way that if you don't want to touch your principal yet, and keep in mind before I go down that whole rabbit hole, eventually you probably do want to dig into your principal, right? Because let's say, like, I'll use an extreme example. Let's say you're 90, right? Life expectancy is below that. Let's say you're 90 years old and you've still got $1 million portfolio left, right? Unless you've got your goal is like, oh, well, I want to dedicate all that charity or give it to my kids or whatever, right? Most people probably aren't in that boat, right? Most people are like, well, if I have $1 million left when I'm 90, then I messed something up because I could have spent that money when I was younger and healthier, that kind of a thing, and actually enjoyed life, travel with my grandkids, that kind of a thing, right? So I do want to preface all this by saying, sure, especially if you're doing an early retirement, I totally get not wanting to dig into your principal, right? Because that stuff that's supposed to sustain you. Like in my case, it's like this is supposed to sustain me for 60 years, right? So I also was like, I don't want to touch the principal at all. How can I make sure that doesn't happen, right? But once you're older, you actually probably, for most people, you do want to dig into the principal because you could spend that money, right? Enjoy it, you've earned it, it's yours. You can still donate to charity, right? But some of it you maybe want to spend with your grandkids or your kids, or whatever the case may be, or donate to a cause that you feel passionate about. So okay, so with that said, so the way that we did it is there's two types of income that would come from the investments, right? One is like actual income in the form of either dividends or interest, right? And so I had a portion of it in like a hydro savings account, so that's coming in as interest. So I would spend that for our spending money, and the investments that we have, the equity, so the stocks, those would issue dividends. So in our case, they would, with the investments I have, they basically issue dividends every quarter, right? So those just show up in your account, like in your Quest Street account, as cash, right? And so when I was not retired, I would just take those dividends and use them to buy more of those same ETFs, right? Because then you get that compounding effect. Once we actually hit retirement and we now wanted to live off our income, I would take those dividend, like, the cash from the dividend payments and from the interest out, and I would use that, to buy groceries, pay the property tax, etc. Right? So that's the one type of way that you fund your lifestyle, right? But that probably is not going to be enough unless you've got a really giant portfolio. That's probably not going to be enough to actually pay for all your living expenses over the course of the year. And so then we get into the whole thing, okay, well, I need to actually sell some of my investments to generate cash that I can then live off of in retirement, right? So that part gets a little bit more complicated. So there's different ways that you can do it. The way that I personally, and then there isn't, again, there's no like one silver bullet. It has to do with like your comfort zone, things like that. There's lots of different approaches about it. So I don't think there's like my way is the only way, because also a lot of it has to do with like, can you sleep at night? Are you comfortable? Other income sources? Can you go back to work if you need to, if the markets dive 40%, things of that nature, right? The way that I did it when I first retired, which made me feel comfortable, is I would say, okay, I would see, how the markets are doing. And again, I did not want to dive into my principal either at that point, right? So if the markets went up, let's say 8%, which is like roughly like the average that they're going to go up, right? Then I would say, okay, the markets are up 8%. So hey, what if I took 3%, 4% of my portfolio if I took, that basically, what if I just took what it gained that year, or just a portion of what it gained that year, right? So if it's up 8%, maybe I just took like half of those gains, for instance, right, to live off of, right? So in that case, it's kind of like, and I hate to compare like investing to a casino because it's totally different, right? But it's sort of like when you hear people talking about like playing with the house's money, right? How you've already won like the $100, and so now you're just playing with that $100 that you gained. You're not touching your principal. It's kind of similar in that way, even though I'm very reluctant to use gambling as an example because, again, this is all totally different, right? But it's a little bit similar in the sense that you're not gambling, obviously, but the markets are up. So let's say you're up $100,000 or $50,000 over that past year, above and beyond your principal. So now you take a portion of that $50,000 to live off of, right? So you say, okay, what are all the income sources that I'm getting, right? Am I still doing some part-time side income work? What am I getting in dividends? If I'm retired, am I getting government benefits, right? What are all the different parts of income that I'm doing? And then once all that's in, how much more do I need to fund the lifestyle that I want? Is it $20,000? Let's say there's a $20,000 deficit. Okay, so you can say I want to take $20,000 out of the gains from this past year. And hey, look, my markets went up 8%. So maybe you made $80,000 that in your investments. You're only taking out 20. So sure, I mean that's a very sustainable scenario, right? Because you're not even taking out all the gains, you're just taking out a portion of the gains. And so that is one way to do it. And that's what I did, right? Is I would take a portion of our gains to live off of, and it was fine. Now there's going to be years, of course, when the markets are not up 8%, they're not up 1%, they might actually be down 30%, right? Things like this happen as well. And so then you kind of get into this whole other thing of, well, how do you want to manage those years, right? So in our case, and again, there's different ways, and this could be like a whole multiple um, presentations just on this piece alone. The way that I personally did it, what made me feel comfortable and what let me sleep at night, is I basically had a cash cushion, right? And so I knew what our spending is every year. I knew what sort of dividends we're going to get every year. And so I made an assumption, hey, if dividends got cut 25% because companies are less profitable, because we had another 2008, okay, so my dividends just dropped. I'm not making as much there. I don't want to sell anything from my equities, right? Because the markets are down 30, 40%, whatever the case may be. I look at all the other income sources that I have. Like if you're close to retirement, you might be getting CPP, you might be getting OAS, you might be getting a pension, right? You want to factor all of that in. And then, yeah, what is sort of that deficit that I have? And then can you just make that up? Can you use basically the cash cushion that you have, or like a bond ladder, to pay for that, whatever that deficit is? So like in my case, practically speaking, like I'm a big fan of EQ Bank. They have a really high interest rate account. So that is actually what I used and continue to use for my cash cushion, right? So I had a bunch of money sitting there in a high interest savings account. Yes, it's not making as much as, if I'm an equity investor, but that's okay. That is the safe portion of my portfolio that is there in case we do have that 30% COVID drop. And let's say it stayed that low for a while, that can sustain me for a certain number of years, in addition to all the other income sources that I have, so that I do not have to dig into my principal. So that's the way that I personally did it. And then how big of a cushion do you want? That's going to depend, from person to person, right? What is your comfort level? There's opportunity cost, right? Some people will say, I want a 5-year cash cushion. Okay, fair enough, right? But keep in mind, by having that much cash tied up in like a high interest savings account, you're missing out on a lot of gains when the markets are having good years, and markets go up more than they go down if you're a total market index investor, right? And so you've got to sort of find that sweet spot of what makes you comfortable, right? So I can't remember exactly what number we used. I think it was 3. I might have used 3 years, I think. But then, like I had some money come from the podcast, stuff like that as well. So it's like, okay, that can help cushion. Plus we can lower our expenses a bit, that kind of a thing. So it's kind of like I try to have as small of a cash cushion as possible, while still being able to sleep at night and be comfortable that if markets did fall 40%, I was still able to basically sustain ourselves for a length of time without having to sell equities while they're at a low. So that's how we did it, and that's how I continue really to do it. So it's really just the cash cushion amount that fluctuates based on what's happening in your life. Do you have other income sources? If yes, okay, maybe you can make that a bit more. Can you more or less, depending what it is, right? Are you able to, if there's a 40% drop, can you go and like do some consulting to make up for it? If yes, awesome. So maybe have a lower cash cushion. If no, then maybe have a higher cash cushion so we can sustain you longer, right? So it really depends. Like, can you do some extra work? Can you cut your expenses, or are you already living like bare bones, right? If you can cut your expenses by 10 grand a year, if things get really tough, okay, well then maybe you need a smaller cash cushion because you're okay with that. So long answer, if you went down every option, it's an even longer answer, but that's at least how we personally do it and how we do it today. Whew, that was a big one.
That
I can
was
talk about this for hours, so you got me
very
going.
thorough. No, it's very thorough, and you're so passionate about this topic. Like John said, like thank you, Cornell. Appreciate your knowledge-based passion. Um, Really amazing. But again, Cornell, thank you so much for attending and presenting this amazing information, and thank you for hosting this incredible summit. That you're getting some of the smartest financial experts. They're going to be doing really in-depth presentations on different financial topics. If you haven't got your ticket, click the link in the chat box, sign up for the Canadian Financial Summit. If you enjoyed this, it's just a tip of the iceberg of what's at this summit. It is jam-packed with information and value. So thank you so much, everyone, for attending this class. Cornell, thank you as always, my friend. And if
Yes,
you have
thank you
any
as well.
other, yeah, it's just always a pleasure to speak to. Always so much fun in hearing this great presentation. So have a great rest of your day, everyone, and we'll see you at the summit.
All right, take care, everyone. Thank you.